It is April 24th, 6 p.m. Eastern Time. Time for talking about options, how to navigate volatility with options in today's markets. My name is Daniel Sinek, and I'm greeting you today from our beautiful office here in Montreal, in Canada. And before we get into the markets, and before I introduce our guest, Jim Kenny, the option professor, let me guys ask you, where are you calling in from today? Who do we have? Please put your location into the Q&A box of your Zoom tool. Who do we have today? Let's see. And we do have a full room, so please share your location. Put it into the Q&A box. Who do we have today calling in from? I know Jim is calling in from wine country, California. Oh, perhaps similar to where Chris is right now. Chris is in Northern California. Maybe you guys can exchange some notes afterwards. Hey, Chris, good to see you. And I did see your message about Mod of Wave too, Chris. I'm gonna get back to you. Tian from Garden Grove, also California. Hey, Tian, how's it going? Art from Frederick, Maryland, from the other side of the country. Rakik from London. That's London, Ontario, or London in the UK. I guess it's the UK, probably. Daryl from Wyoming. Hey, Daryl. Good to see you. All right. And Rakik says the UK. Yes, I assumed so much. Wow, it must be late there for you. What time is it over there? 11 p.m.? Something like that, huh? Awesome. Perfect, guys. Okay, thank you so much for sharing your location. I do have two more questions. So first off, who of you is joining a webinar from Trading Indicators, our company here, for the very first time? Who do we have? Anybody joining here for the very first time? And Chris is asking, no Aubrey today? Well, it's too late, probably. Cyprus must be 1 a.m. in the morning now, probably. Okay, Rakik is here for the very first time. Awesome. Well, thank you so much for joining, Rakik, and welcome to our community. It's nice to see you. Daryl for the first time. Hey, Daryl. Also nice to have you today. Welcome to the club. Welcome to our trading community. Awesome. Well, thank you so much, guys, for all this information. Let's get into it. Okay, a couple of housekeeping items first. First off, this session is being recorded, of course, and the recording will be posted shortly afterwards on our webpage at tradingindicators.com/alerts. I'm going to post this link also into the chat box in just 1 second. So tradingindicators.com/alerts for the recording of this webinar. Alternatively, you can also find it on our YouTube page, which is quite easy to navigate to. Simply go to our homepage, tradingindicators.com. Top right corner, there's a YouTube icon. Click on it, and it will bring you straight to our YouTube channel. All right. Also, please, when you trade options or stocks or really any other asset class, please keep in mind that trading these symbols does contain substantial risk and therefore is not suited for every investor. If you trade, make sure to only use risk capital, which is money that you actually can afford to lose. When it comes to backtest performance or hypothetical performance or anything really based on historical data, keep in mind that this is not necessarily indicative of future performance, and any trade ideas and strategies discussed in this webinar should not be construed as trade advice. These are for educational purposes only. All right, so for Rakib and Daryl and perhaps anyone else who's joining us here for the very first time, well, we are tradingindicators.com. My name is Daniel Sinek. I'm the guy here on the left-hand side, and we've been in business for almost 10 years. We're nearing our 10 years anniversary. And as the name suggests, we specialize in building trading indicators. We've built almost 1,000 of them for clients all over the world. This is really our bread and butter, and we have extensive expertise in building these indicators. However, we also do other stuff. We build trading scanners, we build trading dashboard, we build fully automated trading strategies. So basically, a round trip shop for all your trading needs. Most of what we do is based on what's called technical analysis, which is basically a pattern analysis or a mathematical analysis of your price chart. We believe that fundamentals are almost immediately priced in, and by analyzing your price chart from a technical point of view, you will indirectly also take into account fundamental information. And one last thing before we get into it, if you have any questions, please don't be shy. the more the merrier. Put those questions into the Q&A box, simple requests, further explanation, just simple questions, put them into the Q&A box, and we will be more than happy to get to those as this webinar progresses. Okay, so enough about us. Now it's time to talk about our special guest, the option professor. Jim Kenny is in the room. Hey, Jim, how are you today? And
Great to be here, Daniel. Great to be here.
it is great. And I don't know if you heard in the beginning, I said you were in Northern California, and this is Chris also is from Northern California. So we have a little, wine country combination right now. But of
Yes,
course,
yes, yes.
perfect. Jim, quickly introduce yourself, and then we're
Sure.
gonna get on with this webinar.
Okay. Well, I'm Jim, the option professor, and I'm a graduate of Boston College. I went to the executive management over at UCLA, and I've been in the options business essentially my whole life, mostly. And so I had advanced training at the Options Institute in Chicago at the CBOE, and I did a tremendous amount of business through buying and selling options throughout my career, thousands and thousands of contracts. And of course, I'm very familiar with all the different strategies. So basically, what I try to do, as what Trading Indicators tries to do, is educate you and try to give you insights that would hopefully make you a better trader or help you on your way to becoming a better trader. And that's what I'm going to do here today as well. So
Perfect.
I'm very happy to be here, guys, and I'm here to help.
Excellent. Thanks, Jim. Thanks for the quick introduction. Jim is going to come on in just a second again. But before we do, let me share with you what is our agenda today. What's planned for this webinar? Well, we're going to introduce really quickly why you should consider options in today's markets. And for this, we need to quickly understand what are options all about, what makes them special, how to trade them, how to buy them, how to sell them. So that's going to be covered in part one. It's going to be a quick overview. We do have additional resources, but this overview is meant to give you the basics to fully understand what Jim will do afterwards when he's going to give us his market review and, of course, share with us what to watch in today's markets. It is fairly volatile out there. Not every symbol is equally good to trade potentially. So Jim is going to share what his viewpoint on all this stuff is. We do have a special offer coming out as well, so please stick around for this. It's for this webinar only, and there will be time for Q&A. Now, what are options? Why should you consider options trading? And I do understand that for some of you, this will be basic, but for some others of you, perhaps it's the first time you hear about options or you never really considered options for your trading. So give me 5 minutes, please, to introduce this concept to everyone. So what are options in a nutshell? Well, basically, an option is basically a contract between two parties. And the buyer of the option, the one who buys the option contract, he gets the right to buy or sell a security, a stock typically, at a certain price for a certain period of time. Now, this is a right, not an obligation, and every right, of course, comes with a price. This is why an option, an option contract comes with a price. You have to, pay for this right. And sometimes this is more expensive, especially if market conditions are quite volatile, and sometimes it's a bit cheaper. And perhaps this also alludes to you that, not every day is equally good for buying an options contract. You don't want to buy when things are high and expensive, because eventually you have to sell it. You want to buy when things are relatively affordable and sell them at a higher price. Now, this applies to many concepts in our daily life, but also to options trading. One technicality also is that one options contract gives you the right to buy 100 shares of an underlying stock. Okay. And what comes of this is that naturally, because there's always 100 shares involved, if the underlying stock price is fairly high, let's say, perhaps, I don't know what's high right now, Amazon, for example, or Meta, which are trading in the 200s or 300s, well, then you have to pay, of course, more for this contract because the stock price is higher. If your underlying stock is a bit less, then the options contract will be a bit more affordable. But it doesn't mean that, these are good times to buy, just, so you understand the correlations. Higher price stocks typically also have higher options pricing. Now, why would you consider buying an options? Well, the reason for this lies in the name. You have the right, but not the obligation, to buy an underlying security at a certain price. So you pay a premium for this right, but if, for example, your stock is trading below this price, if it's a call option, you can just let your options contract let go. You don't have to exercise this right, and everything is fine and dandy. All you have risked is the premium that you've paid for the options contract, but it stops there. In other words, your risk is very calculable. It's absolutely known at the beginning of your trade, presuming you are buying options and not short selling them, and the risk is limited. And this is really where the key advantage of options trading comes in, especially in very volatile markets, which are quite unpredictable. And perhaps it's a good time to hedge your risk or to limit your risk. However, you have limited risk, but potentially you can still have big gains. And this comes in because, options trading can be leveraged. Yeah, the broker typically will leverage your trading by a certain factor, which you can which allows you to buy option contracts above your account size, for example. But of course, this also comes with a risk. So you have to be aware that leveraging not always is the best idea. All right, now let's see what kind of options we can buy. But typically, there are two types. Well, actually, not typically. There are two types of options that you can buy and trade. One is called call options, and the other one is called a put option. And what's really important is that, even though an option contract gives you the right to buy or sell a security at a certain price, typically, not always, but typically, I think perhaps 90% of all times, you will sell your options contract before it expires, before the expiration date. So you don't even, exercise your right, you will sell it before. And there are reasons for this. Risk management is one big one for this. We have a whole masterclass recorded on this topic if you want to get more into the weeds. So typically you buy an options contract and you sell it before it's being exercised. Just keep this in mind. Now, there are two types of contracts. There's a call option and a put option. And a call option, as mentioned, gives you the right to buy an underlying security at a certain price, which is called the strike price before expiration. So there's always three components. Whether it's a call or a put contract, what is the underlying asset, what is the strike price, and when is the expiration date. So all these things need to come together. And there's really an art and science to pick these correctly. And Jim, the option professor, is going to talk about this a bit later, because with all these things involved, yeah, you all of a sudden not only have to get your the directionality right, whether the security is going to go up or down, but you also be right about when or how to pick your expiration date, what strike price to pick, and so forth. So option trading is a bit more complex, but when done correctly, you can really leverage it to limit your risk and improve your trading. Now, if you buy a call option, what are you hoping for? Well, a call option basically gives you the right to buy a certain security at a certain price. Now, the idea here is that this is a bullish strategy. So you are hoping for that the underlying security, be it IBM or Facebook or Google, whatever the underlying stock is, the hope here is that this stock will go up in price. And if it does, your options contract will gain in value. And the idea is then to sell it at the higher price, of course, as you bought it. And that's always the idea. When you buy something, you eventually want to sell it at a higher price. And this is why, buying an options contract is, it's very crucial there that you buy it at a very affordable price, which allows you perhaps later on to sell it higher. That's very important. Now, put options, it's a bit the opposite. A put options gives you the right to sell an underlying asset at a certain strike price before expiration. Now, it's quite the opposite, because for put options, when you buy a put option, you anticipate or you hope for that the underlying security is going to go down. And if it does, the value of your options contract, of your put options contract, is going to increase. And of course, once again, since you're buying an options contract, you want to sell it for a higher price later on. The beauty about options is that, when you buy an options, all you can lose, and there's really no exception for this when you buy an options contract, all you can ever lose is what you have paid for the premium. Okay, so that makes it really interesting for managing your risk. And this is just to give you an example how you can buy an options contract. This is what's called the options chain. What you can see here, for example, is the strike price. It's this one here. Not the strike price, sorry, the expiration date, which is this one here, April 12, 2024. That's an older screenshot. So all these different contracts are for sale with this expiration date. Okay, that's one component. What you can also see here are the different strike prices. Yeah, you can see it here. This is the strike price: 139, 140, 152, 172, 202, and so forth. You can see it here. These are all the strike prices. And on the left-hand side, you have your call options, which you can buy at a certain price, strike price. And on the right-hand side, you have your put options. And guess what, guys? And again, once if you're new to this, this might be a bit overwhelming. There are option strategies out there which involve buying both sides, a call option and the put option at the same time with the same expiration date, but at different strike prices. Strategies out there for this as well, which serve a certain purpose. And what these are and when these come in, Jim perhaps will touch on it right now. But most importantly, all of this is explained in our options masterclass, which is 6 hours of options education, pre-recorded in 3 sessions, which will teach you everything you need to know about options. What are the most important strategies? How to combine different option strategies? What are the benefits? What are the risks? What are the disadvantages? And guess what, guys? At the end of this session, we will show you, or give you an option, we will show you how you can get this options masterclass, which normally costs $397. Today, you can get it completely for free. So please, please stay tuned for that. All right, that was the theory part. Now let's get practical. Jim, what do you see in today's market? What kind of day did we have today? It seemed a bit bullish to me, wasn't it?
No, the market seems to be going to certain points. In other words, earlier, a month or two ago, I was saying we're up at 6,100, 6,000. When it started to break, I thought the furthest it would go would be 4,800. It went there very fast once we broke 5,800. So we lost 700 S&P points fast because the market, in my view, goes to destinations, particularly when they're extremely volatile. So that's why it's very important that we have levels. Should I share screen or
Let's
just
do it.
discuss? Okay, good.
No, share. Let's get practical. Let's look at the chart.
Okay, and I am enabled to do this now.
Hang on. You should be. Now, yes.
Okay. I have your screen up here, and I need to get my screen up here.
Let me just stop sharing for a second. I'm gonna go back on camera. Stop sharing. There we go.
Okay, that might
Please
be more
go
helpful
ahead.
because I can see my screen now at least. That's got to be a good sign. Okay, now I've been enabled here, and I'm sharing, and I'm clicking, and I'm sharing, and we're rolling. Correct?
All right. Not
Oh,
yet.
share right here. Yep, right there.
There we go. Now it's building up. Perfect. Thanks, Jim.
Okay.
Yeah, please
Okay.
take it away and make it full screen if you can, if that's an option
Well,
there.
that would be lovely. Perfect.
Yeah, looks great. Perfect. Go ahead.
Okay, guys, this is, because I've been doing this for a long time and I've seen a lot of crashes. In other words, I was around for the 87 crash. I was around for the dot-com crash. I was around for the great financial crisis crash, and I was around for the COVID crash. So I'm crash experienced. And what I do during crashes is I try not to get involved in what they call no man's land. So let me explain what no man's land is. No man's land is anything between like 5,900 and 5,600. No man's land, anything between 5,700 and 4,800, no man's land. So what we try to do is we try to find key areas. So if you were getting my alerts, I would have been explaining to you in either the beginning section of the alert or in my market review that when we were breaking under 6,100 and 6,000, the market was turning into a downtrend, and it had a good likelihood of reverting to the mean. So if you would have been talking to me in one of the sessions, I would have said, you see, we're way up here at 6,100, and the mean could be as low as 4,800. It could stop at 5,200, or it could stop up here. But if it's going to have more of a significant reversion, and when you announce that tariffs are going from 0 to 150%, you're probably going to get a full reversion. So again, that's where I got the 4,800 number, from my reversion here to right there. So if you had stocks or you had long exposure and we had spoken and you had read some of my opinions, you would have known that this is a dangerous time to just be holding on to your stocks. Now, again, when we go over here, we notice that it tried to bounce a little bit here, but can you see when these lines are pointing down, that's a downtrend. And this here is an uptrend. So if you were wondering why you made money between May of last year and February, because we were in an uptrend. If you don't change your dance moves when the music changes, you're going to step on your feet. So again, when we're down here, it's a no man's land and it's going to bounce back towards the mean. This is the mean. These moving averages are called reversion to the mean. So you don't want to be selling out of your stock down here. But as you come up to this neighborhood, can you see we just hit what was the high today? 54.89. And can you see there is a moving average at 54.93? That's only a few points away. So there is some resistance here. And this is the neighborhood of a 50% pop from there to there, and then a 50% up. There's also a Fibonacci number, that old Italian mathematician, and it's 61.8%, which would take you somewhere into the neighborhood of the gold line. So my suspicion is that they may try to bring it up towards the gold line with some more good news if they can get through here. And if they can get through the gold line, I think the best you're going to do is a purple up at 58.23. So now you've got places where you might want to do some business. Meaning, if it can't get through here, your put options might be quite good. If it can't get through here, your put options might be quite good. Because again, after a rally, if the news doesn't really improve and earnings were to drop in Q2, then you could see the PE ratio contract. And right now, when we peaked out here, earnings on the S&P was 270 and the PE ratio was 23. That's why we topped out here. So if the earnings are going to be less than 270 and the PE ratio is going to be lower than 23 to 1, then you could end up somewhere in this neighborhood if we just got a slight pullback in the earnings. But again, these are two numbers that I would think, and you got a gap there to fill. So I would think somewhere in this neighborhood and somewhere in this neighborhood, if it falters, might be the time to look into the puts again. Now, I've been using the short-term graphs as well, and particularly the 1 month. And as you can see, it's right up here. It went through the purple, so now it could go up to, remember I told you 56.50? That's the neighborhood. So you'll sometimes see on different time zones a similar number. So keep 56.50 in your back pocket because it shows up here and it shows up here. And does it show up on the 5-year? Yeah, it kind of shows up on the 5-year. That's called the Triple Crown. So 56.50 is a neighborhood where if it goes up there, I would be looking to see if it might fail. And can you see the 5800, 5823 neighborhood comes in here? And I think if you go over to the 20-year, you'll see that the red line is at 5,700. Okay, so all of that neighborhood is called resistance. And the reason it's having such an easy time going back there is because they're changing the news around a little bit. I mean, obviously, we've gone from everyone's going to pay $1 zillion in tariffs to, well, maybe not so much. And, we're not negotiable on anything to, hey, come on by, we'll talk to anybody. So when they change the music, people who are short are going to cover, and people who are out might take some buys. But to say we're out of the woods right now and that everything is happy dory again, I think is premature. I'm still looking at this as a rebound rally in a bearish situation. And as I said, the longer we stay under 5,800, these lines start turning down, it'll look more like 2022. So I'm not saying I'm viciously bearish. I'm just trying to say is that the longer we stay underneath this 5,800 area where these numbers are, and the more that these averages turn down, then your risk is retest. Then your risk is the gold line. And if we ever hit a real recession, your risk is right down here. Well, I'll show you really the big risk is down to 3,500. And the way you get 3,500 would be 17 times earnings, and the earnings drop to $200 from 270. And maybe real estate takes a hit because you know what? Real estate sales are at the lowest level since 2009. And you know, if you ever break real estate prices, people are definitely going to feel poor. And if they feel poor, they're not going to be thinking about spending all their money like they have been. And if the unemployment rate ever goes from 4% to 5%, then the fear will be turning into reality. See, one of the reasons the market can bounce so well lately is that the hard data has not turned sour. What is soft data? Soft data is the University of Michigan's calling, and what do you think of the future inflation rates, sir? And how do you feel about the economy, sir? That's called soft data. Hard data is the jobs claims, which came out today, which are pretty good. The unemployment rate, which is still in the fours, pretty good. Retail sales, which are up 1.4%, which is pretty good. And since we're 70% consumer in our economy, unemployment, retail spending, and wages and things like that, they are extremely important fundamentals. And those fundamentals are still firm. All this conjecture that inflation's coming because of the tariffs and that the economy will weaken, this is called speculation. It's also speculative because the actual policies are extremely erratic, which means one day it's 150% on China, and then the next day maybe it'll be, much less. One day it's going to be we're going after Japan. They're going to be buying all the GM cars. You're going to go to Tokyo, and all you're going to see is GM cars. Okay, and then that rhetoric gets dialed back to the reality. Or everyone in Germany is going to move all their factories over to North Carolina. And then the people in Munich will have more time to have Spaten beer or eat sausages or whatever they're going to do in their spare time because they're not going to have any factories to work out. So the rhetoric will change. And when it changes into more reality, it could be helpful for the stock market. And once we start getting above 5,800 consistently, then you can build a case maybe of 6,600 or 7,000 on the S&P because the rhetoric will have dialed back and reality will have overcome, shall we say, fantasy. And then we'll have to see how that works out. But right now, what we know is everyone's working. What do we know is everyone's got some decent savings. And what we know is retail sales are rising. That's what we know. What we don't know is where these tariffs end up and what they will actually do to earnings. And what we will know is as we go into the summer, July and August, we'll have the second quarter. And even that might be early. The reason these earnings are so good is they don't have any tariff problems in there yet. That's why Google had good numbers today. But you notice that they said they're going to come up with 70 billion in buybacks. That's what companies are going to do to make you feel comfortable owning the stock. They're going to announce buybacks so that when you're holding the stock and if it looks like it could be in trouble, you're going to hope that those buybacks will come in and support the stock. So that's what's essentially going on now. And I think it's extremely important that you use levels when you're looking to get in and out of things. Again, I also like the 5-day. I mean, once these things turned up here at 51.20, that red line turns up, it's a good deal. Crosses over green, it's a good deal. Blue starts turning up, it's a good deal. Crosses over gold and purple, it's a good deal. So you didn't have to be from Harvard to go on the long side here, just using the 30-minute graph. You see, these are 30-minute graphs. And just follow your lines. Now we're up here a little bit softer because we have a RSI at 676. And over here, we got the RSI at 71. So it's starting to weaken a little bit. And I did show you that it did run into some resistance ballpark right around here. So that's a neighborhood that I would start sniffing around the put side. If it breaks above there, I can ditch the put quickly and have a pretty small loss. By the way, everything I talk about today, I'm just talking about my opinion. Anything to do with advice or suitability, you always talk to your broker only. I'm just sharing my views and my opinions. Now, So if we were going to think that this could be a dropping zone, and I jump over to the 5-day, I obviously would start thinking it might be turning if we can start breaking under 54.68 and then getting these lines to point down a little bit. Okay. So again, but ideally, you know, I'd love to see it go to 56.50 and 58.25 because by then all the shorts will probably be blown out. And you'll have to find new people who want to buy at 58.25. And if there's no certainty, in other words, everyone's talking about all these countries are coming to the table and all these deals are on the table. But at some point, people are going to want to see the deals or they're going to not believe you. And if we go up to 56.50 or 58.25 and they don't believe Besant and the administration that they actually have deals going, then it could come under additional pressure. Or if Trump were to lose his cool and start wanting to get aggressive with the tariffs again. So anyway, that gives you a little overview on some of the, now, if we look at specific stocks, let's take a look at Google because Google just had some great announcements, right? They, or at least they were viewed as great. I viewed the revenue and stuff on the ads being kind of flat, and I viewed the cloud data as kind of flat. And they didn't come up with 70 billion in buybacks because they don't think there's any problems. But you can see it's going to where numbers are important. You see, this is no man's land. Once it breaks above here, it's going to go toward 175 to 180. And this is the neighborhood. If it fails, it'll be another possibility for a put. But do you see this gap here? If we come out of this thing fine and we don't get unemployment to rise and we don't have the economy slow way down and the consumer keeps spending, we're going to be filling that gap. Okay, so we're still down here. And this looks like a nice Fibonacci pullback, one move, two move. So when we break above 165, which we just did, because you see it's at 169 in the aftermarket, the likelihood we're going to 175 to 180 is increasing by the moment. And it probably is going to end up going there. But this is the neighborhood where if the news changes, it could come back down. If we were to get above this 175, 180, then the logical place to go would be 195 to 205, which ultimately it might be going to if things break well. And again, with everyone pounding the drawer on how it's going to be inflationary and the economy is going to stop and everything's going to end badly, well, that's a lot of people positioning that way. And that's why the upside has had a pretty good time of it lately. One, because it's way underneath resistance, which it's going to fill that gap. And two, because positioning got very, very negative. And third is the policies are flipping the other direction, which is really understandable because did you really think they're going to keep those hard policies and we go to 2000 on the S&P? I mean, do you think he wants to lose every election from here to eternity? No. And that's why the countries who are negotiating with us now probably are going, what are we in a rush for? This guy's on a clock that he wants everything done by June. I'm in China. We deal in centuries here, not months. And so the bottom line is it could be very much difficult to negotiate with people if they think you're already hitting the panic button and backpedaling. So that is kind of the story there. But that gives you an idea, again, and if you look at the short-term graph, I mean, Alphabet told us to get long this thing at 149, 150. This is no surprise Alphabet's rising. And it's really no surprise their earnings are going to be good because they're not factored into the tariffs yet. And everyone uses Alphabet. So the bottom line is that this has pretty much been telegraphed for a while. And this is going back 5 days. So pretty much an obvious thing there. And that's why I love using the 30-minute graph because you can get on the train and off of it right away. But as long as the averages are rising, the likelihood that the prices are going to be rising is pretty good until you get to a point of divergence. And we're not there yet. I'll show you one thing on the gold. Because this is something me and Daniel talked about on Tuesday. And people who listened to me on Tuesday, I think they should be happy today because what I told them on Tuesday is right here. You see here? This is called 34,500 to 3460. And when this thing rolls over and I go, this is exactly what I said on Tuesday. This baby is overbought and it is a poster child for reversion back to the mean. Let's go to the 5-year graph. A poster child of overbought and reversion back to the mean. And that 3,000 number might be where it could go at some point. And then you go to the 1-year graph and you see it already reverted to the green and the mean. So at least you were going to get 200 bucks out of it, right? Because right here in the 5-day, you got a beautiful sell here, and you could have ridden it all the way down just on the 30-minute graph. That's 200 bucks. 200 bucks on 100 ounces is 20 grand. And then, of course, when it turns up, you've got a cover. And now it's back on the bicycle here. Okay, but this is a nice little catch, wasn't it? And this is what we talked about on Tuesday, because when we had the meeting, this is where it was trading. It's here when we had the meeting on Tuesday. And here it's Thursday. So you could have had the gain, flipped it around, you're long at 3,300, and you got 70 bucks to the good. Not bad. But this is why it's very important to find your spots. You don't sell it, you don't do shorting on this kind of look. This is called bullish. You don't sell it there. This is called standing in front of a freight train. This is saying that, let me see here, 79 was your RSI, and over here it's 70. That's a divergence. Then it got under the red line. That's your signal. Then it got under green. That's a signal. Then I got under blue. That's a signal. And then you're in under purple. That's a signal. And then you rally back to green. That's a signal. And it never got turning up, never got turning up. And here's where it started to turn up, right around 3,300, 3,320. Okay, so that's and again, we have this coaching session. Okay, when you're a subscriber, you get coaching, and all you got to do is text me. We'll set up a time. We'll walk through your stocks, your ideas, and I'll try to give you my input on how I might be able to enhance and hopefully improve your strategies. A lot of people have done credit spreads. And again, they've had a lot of problems with those because when the market gets very lineal, goes in one direction, and you're on the wrong side of that direction, either put or call, it's a real problem. So I can explain risk management and timing. And both of those can be very, very helpful to people, particularly if they have less experience than myself and they would like to learn a little bit about some of the, shall we say, experiences I've had and how I try to risk manage things like credit spreads or iron condors or all these other multi-leg strategies that are out there that some people, think are of very little risk, which many times they might be. But when the risk does come home to bite, it can bite pretty hard. So that gives you a little bit of an idea on a couple of ways that I try to read the markets a little bit. Next week, we've got a lot of different stuff coming up with regards to Apple and Microsoft and Meta and Amazon. This stuff could give you the fuel to get to the 5650 or even the 5825 area that I'm talking about. And then after you get up there, the focus will be on second quarter earnings, and they'll be on how many countries are actually striking deals with the US, and has the policies changed again? Because again, according to what I read, China is sticking with take all those tariffs off and then we'll talk. And the US is trying to go with, hey, come to the table and we'll talk and we'll have bread and water or whatever we're going to have, and that's not, they're not interested in that. They don't want to be threatened. They don't want to be, extorted or any of the other feelings that they have when you put them into a corner and you try to jam them into something. That just doesn't seem to be the Chinese way. Now, whether we agree with it or not, if they're the other side of the coin, you have to kind of respect their viewpoints a little bit if you want to get a deal done. So anyway, it could be very interesting, but next week is going to have a lot of different stocks out there. I was wondering out loud if there was any stocks that you guys had that you wanted to put into the chat box.
Yeah, please put those into the chat box. Let me see if there is anything yet. No, not yet. But yeah, if you have a symbol in mind, guys, please do it. And maybe we can just take a quick look at NVIDIA, Jim.
Sure.
The poster child from last year. What's going on
Yeah,
there?
yeah. Well, again, it has a wall of voodoo at 125. So if you're ever going to make a lot of money on Nvidia, you better figure a way to get above 125. Because as you can see here, there you go. You got the red line coming in at 118. That's going to be door number one. Then you got a couple of doors up here at 130. So this thing is going to have to figure out a way to get above these numbers here if you're going to make any big money on Nvidia. And again, it is, when it came down here near purple, you can take your shot down here because you're somewhat near sea level, right? But now you're in no man's land again. And that's not really where I like to do a whole lot of business because, yes, it could easily pop to 120, 130. It could also go right back down again. So it's kind of a tough racket right here. But you're
Yeah.
a big believer. If you're a big believer, you can buy it here. And as long as you're willing to take $26 worth of risk, you can buy all you want. But personally, I like to do my business near the lines, near the lines. Otherwise, I think you're doing it in what they call no man's land. And no man's land puts a lot of emphasis on luck, and luck always runs out.
Yeah. What about Constellation Energy? It's changed it up.
Yeah. Well,
As
Constellation Energy was the one that was going to open up all the nuclear plants for Microsoft. And then Microsoft called in and said, hey, we're not going to do the data centers like we thought. And that was the end of Constellation Energy. So you want to know where it was up here? Because they were supposed to have partnerships with Microsoft, and 3 Mile Island was supposed to be reopened and turned into a lovely paradise of power. Unfortunately, Microsoft looked at the tea leaves and they said, I think we're a little above our skis here with the data centers, so let's dial those back. And that, of course, brought this down here. Now, here is where you should have taken a bite of the apple, right at 160, right when it hits the line. That's where you do your business. Now we're back to no man's land. So could it go to 240? Yes, it could. Could it go back to 160? Yes, it could. Do I know which way it's going? Not really. Let's look at the 5-day. Yeah, the 5-day got you on here at 192, and you could ride it so far. And let's see how that RSI is doing. 77 here and 69 here. So it's a weakening situation. So I would put this on a little bit of an alert to be careful of it. Because again, you want to do your business when it's time to do your business, not just when you feel like doing it.
yeah,
And
agreed.
so that's
What
it.
about Amazon? Good old Amazon.
Yeah, well, Amazon's coming out next week, and I'm sure they're going to show that they're making money. Again, Amazon way away from the averages, so we were looking for a reversion to the mean, and then down here is when you got a pretty good reversion to the mean. So this would be the neighborhood. I mean, if this thing's at 150 and you can buy it at 160, that's not too far away. And now it's run up to the red, so it's a little problem there. But then you've got the bigger problem at 210 and 200. So this thing could, again, the reason it's bouncing is there's nothing stopping it here. It's very easy to bounce from 160 back up to 200 because there's nothing there, nothing there. So this is called the easy bounce.
What about
And
what about
hmm,
Tesla afterwards?
well, let me just show you here one
Yeah.
last one. You remember I said 200 to 210? Well, you got two. That's where it's going to be having trouble in there. Tesla, I thought, like I said on Tuesday, that their earnings probably stink because they're not selling any cars, but that I was in San Francisco at the time and I saw 9 million Waymos. And I told everybody on Tuesday that don't worry about their earnings because that's not why people buy this stock. They buy it because, according to Elon, he can make the Waymo taxi for 30,000, and the Waymo taxi costs them 150 to 300 grand. So imagine if you could produce a taxi for 30 grand that people are paying 150 to 300 grand. That would be very, very profitable if it could happen. And it could also be at 30 grand used around the world. So the dream here is that at some point they're going to have 9 million of these $30,000 robo taxis everywhere from Bangkok to Bangladesh, and that everyone is going to be using them. And the profitability is going to be off the charts. That's the dream. Now,
That Yeah, Jim, real quick, sorry, a little segue here. I have yet to use a driverless car. Anybody out there who's taken one? I imagine some people from California probably have had the chance. I,
If you live in San Francisco, you have because it's on every block.
yeah, crazy world we live in. But yeah, maybe put it in the chat if you have taken a driverless car before. This is on my bucket list for this year, by the way.
And the
Okay.
other issue is also the cost. The cost to drive to get a Waymo cab is higher than the norm. But if you made it for 30 grand, you might be even undercutting all the taxi people. So, like I say, it's a big unknown world out there. If he can deliver, which is a big if, as he says, then obviously it could be a very big turnaround. And clearly, this particular stock, I'll show you why it was such a good bargain down there. You see, this is the place you want to buy right around the 230 area, like I said on Tuesday. And now it's already 30 bucks above that. And if you can get it back above 300, it's back on the bicycle. And if it gets above 350, you're back on the Ferrari. So keep an eye on Tesla because it's had its reversion to the mean. And this is where you want to load the wagon. And then basically you're hoping that it gets back going and gets starting to clear some of these averages here.
Yeah.
But you can see right now, getting above this area right here, the gold line of 270 would be quite good as well. And then, of course, you've got a nice runway. So could it spike up after it gets above 270, 280? Yes, because there's nothing stopping it.
Let's do one more symbol. I'm gonna show everyone how to get the masterclass for free with our options alert service. Let's do UNH, and we can look at some other symbols afterwards as well.
Well,
UNH,
UNH
please.
would be interesting because they got so clobbered and it's such a big company that you would think if you can get something like this on a discount, but that doesn't look like a good place. Let's just look at the long term and see if there's anything there. Yeah. You see, this thing here could still go down here all the way to down towards 332. So this one would be something where, it has broken under everything and it's a rough racket. So this would be one that I'd probably stay away from because if you want to know why you made so much money in it over the years, it was in an uptrend and now it is not in an uptrend. And so you have to be more careful buying things when they're not in an uptrend. And there still seems to be quite an attack on the cost because they're looking at the cost of drugs and the cost of all the different things that the healthcare people do. And so if you cut costs, that means you cut margins. I'll give you a for instance here on what happens when they cut your margins or cut your contracts. This is what happens to your stock. Your stock is doing very well, and it looks like it's going pretty good, and it's up here at 250, and then they lose 15 contracts of government contracts, and you wake up the next day, and you're down 20, $30 a share, and so, and now you're back into the downtrend here. So this is an example of cutbacks and how they can affect real companies who have government contracts.
Yeah. Okay, cool. Jim, I'm going to grab the screen for a
Sure.
couple of minutes and I'm going to come back to the charts in
Thanks.
just a bit. All right. So guys, if you are wondering, hey, this sounds pretty good. Jim seems to know what he's talking about. And I'm telling you, he really does know what he's talking about. I've had the chance to work with him closely together to really understand of how he looks at the markets, how he picks interesting stocks, because right now we've done a bit of a roundtable. But if you're wondering, hey, what stock in particular right now is of particular interest, well, then you should consider our options triple play alert service. Because if you sign up every single Sunday, like clockwork, Sunday afternoon, you will receive an email from Jim, the option professor, delivered directly to your inbox, where he shares with you his top ideas, options ideas for the week and the weeks ahead. And these ideas, they include strangle trades. This is a multi-leg option strategy. Don't worry if you don't know what it is right now. The masterclass will help you with this. But it's a multi-leg option strategy which can earn you profits no matter whether the stock goes up or down. As long as it moves from its current price, you might end up with a winning trade. So this is particularly interesting if market conditions are uncertain. And if the only certainty in quotes or somewhat certainty is that, hey, markets are going to move, then strangled trades, which is something that you can do with options, might be the way to go. He will also go get his outlook on where the big indices are going to go and some long-term directional plays, which are more of a speculative nature. All this available at tradingindicators.com/alerts. Let me quickly put this link into the chat box. And while I'm doing this, Jim, please expand a little bit of what to expect from this service while I'm putting the link into the box.
Yeah, there's three things that you can expect. One is you're going to get a course, and the course goes for $397, but we give it to you for free because we want you to understand options as much as possible. So you get the course that helps you understand options. The second thing is you get the alerts. Now, the alerts are not just about the alerts. They are also about a overview of things that I think are very important currently. Like I went over some of the things I talked about now. So that gives you an overview of how I am seeing the markets. Is it, is it overbought? Is it extended? Is it going to revert to the mean? Has the reversion already occurred? And I give you that kind of insight. Then I go over at the end of the alert each week. What does the gold look like? What is the stocks look like? What does the tech look like? What does the interest rates and the oil look like? And of course, one that I would like to talk to before we sign off is the Bitcoin, which I think I've been very accurate in my analysis. So you're going to get a lot of information you can use, including international. After Trump was elected and all the international stocks went way down, I explained to people that this is a big barker and he's probably not going to bite that hard. And everyone has panicked out of all the international stocks. At that point, I said there was going to be a huge short covering rally, which is exactly what happened. So had you picked up Europe, had you picked up Japan, had you picked up India, had you picked up even some of the China stocks like Alibaba at $85, there was a heck of a value there. And that was all explained to you in the alert. So you get the education, you get the alerts, and here's the most important, you get the coaching where me and you talk one-on-one and we look at my charts like I'm showing you. We look at things that you're trying to do. Are you trying to do multi-leg trades? Are you trying to do credit trades? Are you trying to do weekly or 0-day option trades? I can give you my insights into how I would do those, and then you could put it into your calculus and see if it can enhance your ability to either risk management or get better entry levels on these things, because entry and risk management at the end of the day is really the two most important things. So the coaching, the masterclass, and the alerts every week, that's an awful lot of good stuff in my view. And you've got two ways to go. If you've obviously some people have bought other things and they're not happy with them, so they're hesitant. So, okay, you're hesitant, no problem. You try the stuff out for 90 days, $297 because you get the discount. I mean, come on. You go out for dinner a couple of times, you're going to pay more than $297. And how much money do you have at risk in the market? I think certainly more than $297. So there's plenty there that you're getting. And then if you like it after 1 month, you can convert into the yearly, because the yearly is my idea would be the obvious one, because you're getting 4 times the alerts. You're getting 5 times the coaching, or 4 times the coaching, and you're getting the class. Again, how much money is at risk here? I mean, over a year's time, I feel confident we can provide you with enough information to obviously make it more than worth your while. And again, the 4 times the coaching means throughout the year, if you have something that comes up or something on the alert that you read, but you want more clarity on, all you got to do is text me, because everybody gets my text number. And all you got to do is text me. We set up a time and we go through it. And I think, like I say, there's way more value here than the relatively small amounts of money we're talking about. Because again, there's a triple crown here: education, alerts and updates every week, and then you got the coaching. So again, I feel very good that you'll be very happy with this.
Yeah, exactly. And it's been a very popular product, and especially the one-on-one coaching. I think this is what all that makes the difference, because it's not just about options. You can pick Jim's brain about basically anything related to trading. He's probably seen it before and has an opinion about it. So yeah, consider taking advantage of it at tradingindicators.com/alerts. And this link has also been posted into the chat box of your Zoom window. All right. So, meanwhile, while you might consider this offer, guys, do you have any questions at this point or any symbols to look at? If so, please also put it into the Q&A box. So, any symbols to look at? Um, Let me just see if something is
Or
coming in.
strategies. If you have a question on strategies, are you in some credit strategies? Are you in some strategies? One guy I talked to had like a credit put spread combined with a debit call spread, and all kinds of different things. So if you have a strategy question, I'd be more than happy to help. But I did want to talk about the two markets that I thought were in critical zones on Tuesday, and they still look pretty critical. Anyway, I could jump back on and share the screen.
Go for it. Yeah. And one question that came up is, hey, can you check out the Russell at some point?
Oh yeah. Russell, I've been waiting. That's like waiting for Godot, though. You're waiting for a turn. Anyway, let me show you the two that I thought were really interesting here. Let's just, and then, dollar index. Okay, check this out. That thing came right down here. I'm saying that's the low right there. If it's not, we're going into the abyss. So that number here on the dollar index is what? 98.42. Can you see what the low was? Like 98. Very close, right? Very close. And where's the abyss? Right underneath. Okay. So, and then that doesn't look good down here either. I don't like that very good. But if you go to the shorter term graphs, I think you're getting a little bit better action, not tremendous, still under pressure. But I'm not saying this is definite. I'm saying this is starting to sniff like a turn. You see, as long as it can hold right now 99 and get going, it could go up to 101. So keep an eye on it here, because again, it hit a very important point. That's a very important point in my view. And if that has hit the low, then this guy here might be hitting a high. And don't forget, their economies in Europe are not exactly the best. So here we have this thing peaked through, okay? And if the dollar is going to drop to 90, we're going to be trading 124 on the euro, okay? But let's see if there's any evidence that it might have stalled out. Not much evidence here. Obviously, it's extended, so it could revert to the mean a bit. But let's see if there's any other evidence. Let's see what you got here. You got a high point here of 77. And you got a high point here of 76, followed by 62. You reverted to the mean. Maybe that's all the correction you're going to get. It certainly was a good sell at 116 to pick up 2 points. That wasn't so bad. And then on the 5-day, again, you can see it's having a traffic jam. So if you see the euro break above 114 and 114.60, then that dollar index may go lower and maybe going to 90. And if that's the case, then this stuff again can go way up, because I just showed you if it really got going, 124 to 125 is not off the table here. Again, but that 98 on the dollar index is very important. Here's the one that I thought was very interesting, and I think this is obviously a better deal. And I will show you that right now. And that's on Bitcoin. Very happy with my analysis on this. Check it out. Okay. This was my first entree into really getting bullish right in here. You see, we have a traffic jam of all my averages. I know that it's going to have a big move coming out of there. In my opinion, it is a high probability. And with the blue line rising, I said the break was going to be to the upside. So this was a load the wagon deal here. And this was the big jump, right? Now, once it got to 110, I started seeing double top. And then once it got under 100, I said it's going to revert to the mean and fill this gap. Wasn't that exactly what it just did? And then I said, if it fills this gap and holds, which it has, and gets back above 82, it's going to be bullish. And if it gets above 92, 94, which it is right now, it could start really taking off, because guys like Tom Lee still think it could go to 150 grand. So how do you play it? Well, on the alert each week, I show you a long-term option play on MicroStrategy. Why? Because this guy is loaded with, and I talked about this Tuesday, Daniel, if you recall, and this thing was trading
I do
300 on
recall.
Tuesday. Yeah, and I said, this thing is ready to fly like a bird. And again, it needs to stay above here to do that. But this thing here, look at that RSI, that looks like it's ready to rock and roll. And so if this Bitcoin ever went to 150, what do you think this thing's going to do? Go down? It's going to have a huge run. And that's why I thought one of the better ways to play Bitcoin, rather than putting up 80,000 or 90,000 for a token, I thought it might be better to put up a couple of grand and try to make 10 grand by going a little bit out of the money with a call spread going out to Christmas time. And I still think it's a good idea. And I thought it was a good idea down here. And I thought it was a good idea over here. I think it's a good idea today. I still think it's a good idea because I think it has not really broken out yet. Now, if you want to wait for it to go to 500, that'll call the horses will be out of the barn. And when the horses are out of the barn, the only thing you can do is wave to the horses and say, I wish I would have rode you earlier. But again, this is a limited risk speculation with a strong potential gain that goes all the way out to Christmas time. And we all know it's a little hot for Christmas. In fact, it's going to be 100 back in Nevada when I get back there. And so, there's a long way to Christmas and a lot of stuff can happen. And if they start going to easier money, or they're going to be raising the debt ceiling, they're going to be the national, the fiscal deficit already is 1.3 trillion this year. So this idea of austerity is going out the window after June when they start passing these budgets, and maybe they start giving $5,000 checks away to citizens because we saved so much money on Doge. Who knows? All I know is this baby here is going to benefit when people lose even more confidence in a dollar that's already gone from 115 down to 98. So this is the game right now, and I've been trying to slam the table as hard as possible. I didn't think it was going under 250 very far, and it hadn't. I thought when it got back above 280 and 300, it would be back on the bicycle. And I think if it can stay above 350, it's getting ready to fly. So keep an eye on that. I'm not a Bitcoin freak, but like I said, in 550, I have no interest. Down here at 250, call me up. Down here at 150, call me up. Okay. So like I say, that's why I've been very, very, shall we say, optimistic about things, because the blue line doesn't lie. And the blue line's rising. And that's not a bad thing if you're bullish.
Yeah,
That's
Jim,
all I
on
had for you on that.
on
Yeah.
that question, Bitcoin question came in. Why not play it with IBIT, which is a Bitcoin ETF, nine shares ETF, I
Well, you
believe.
could, but if I'm going to take a chance, I'd like to get paid, and I think you get paid a little bit better on MicroStrategy than you do on IBIT. But I'm not an IBIT expert. I'll put up IBIT here and take a look at it. But I don't think you're going to see IBIT go from. Well, maybe you will. This is a 300% jump, and did we get a 300% jump on IBIT? We went from 34 to 60. We got less than a 100% jump on IBIT. So I guess what I'm saying is, if I'm going to play in a horse race, I'd rather bet on Secretariat than the Seattle Slew. If they're both going to be good horses, but I just thought that the MicroStrategy, because he's so leveraged to Bitcoin, you might get the more bang for your buck. But
Yeah.
certainly, this thing doesn't look bad. I'm not gonna throw mud at this. It just seems to be a slower horse than the one I'm talking about.
By the way, the first time I met Jim in Las Vegas, he showed me a video of that horse, Secretariat. I didn't know about it, and I don't really follow horse racing, but it was quite something else. So if you haven't seen it yet, watch or look it up on YouTube, Secretariat horse racing. That was quite a performance, I should say. All right, perfect. Um, Jim, real quick, can you look at the Russell? And then we have a question
Oh,
that
yes,
was asked
please.
by Donna, which we're going to address afterwards.
Now, again, the IWM is at some point going to be the fabulous thing to be involved in. Why? Because it's small caps. And why? Because if they ever bring the interest rates down and they stimulate the economy and things actually look brisk again, these guys would be able to benefit, because these guys, a lot of them are losing money and they have to borrow money. And if you have to borrow money into a bad environment and you go into a recession, these things are going to go way down. And that's why we went down to 170. If you notice, it could not get above the all-time high. So that was your first tip that this whole thing was coming down, because the Russell could not even take out the 2022 highs. You see that? Even though S&P took him out, QQQ took him out, SMH took him out, but these guys couldn't even take out the highs from 2022. That was your first tip that this baby is weak, meaning, all of this bullishness was too bullish, because they couldn't get the Russell going. Then obviously this thing's under the purple line and everything else. So I've been telling people that if we can get above 195, 200, right, then it could start looking better, right? And if we can get that RSI above 50, that would also be good. So try to get your RSI above 50. Try to get this baby to consistently trade above 200, 195. And then maybe you could make a run at the 220, and maybe you could get going. But again, the overall market is in a downtrend as long as we're under 5,800 and 6,000. All of these rallies are bound to fail unless you can get above those levels. So this thing here could rally, but as long as it's under the 220 mark, I wouldn't get the party hats out, because it could just be a rally up. But clearly, it's very inexpensive. Very inexpensive. And as far as its value to the other indexes, it's never been cheaper. So you don't have to sell me that it's cheap. You just have to sell me that it's got some upside. And right now, I'm not exactly sold. Could it have a bounce back up? Hey, listen, if we're going up to 5,800 on the S&P, I'm sure this baby is going to go anywhere between 205 and 220, or 218. So if you want to play for that kind of thing, then you go to your 1 month. Is there any evidence of that? Yes, you got evidence of that. So right now you'd be long the thing as long as it's above 184. Running into some trouble here, but what did I say? If we get another leg up on the S&P, it'll go to 205 to 218. And what's 205 to 218? Right in there. So you got a rally potential here, no doubt about it. Best place to have taken your shot is in the 180 to 184. It's not that far away. And on your 5-day, I'm sure it's been going pretty good since 181. So again, it's in the upswing. So if a guy says, I'm playing it for a further bounce, hey, listen, if S&P is going to 5650 and maybe 5825, no doubt in my mind, this thing's got to rally up towards 205 to 220. So if that's the way you're playing it, this thing starts breaking under 190, I don't think you want to be there. If it breaks under 186, I don't think you want to be there. And even on the 1 year, there's your 185, 186. So it's got to get through a couple of things, but you can see if it breaks through here, it can go very quickly up towards this neighborhood here. So that's the way I would see that right now on the Russell. One day it'll be the greatest place to have bought. That'll only be after we get all of this stuff behind us and all the charts looking like they're going up. And moving averages don't change overnight. I'll just give you, for instance, on what I'm talking about there, so you can keep this in mind. The SPX, you see, on the 5-year graph, you see, these things will not be turning up overnight. See, they didn't turn up overnight here either. So you got to be careful about getting too bullish as long as it's underneath these levels, because as moving averages work, every day you close under these numbers, they are going to continue to point down. And so I'm trying to make sure people don't get too excited. Just because you go from 4,800 and you bounce does not mean that you're out of the woods yet. This is the woods. You want to know where the woods are? 5,800, 5,825, and even on the longer term graph, up here, but that 58 neighbor 5850 area, 5650 area ballpark, that's the woods that you have to get through, and you got to turn them up, which means you'd have to get above 5,800 and you'd have to stay there for a while, because these are 12, 24, and 36, and they don't turn around all the time. So keep an eye on that.
Great. All right. Yeah, thanks, Jim. That makes that makes sense. So technical analysis at its best. And sometimes, as simple and as using moving averages to show your key levels on your chart, will give you the picture that you need to know to decide, hey, is this a good area? Or perhaps wait until price gets more to an extreme. Okay, I'm gonna grab the screen back one more time, Jim. So I'm gonna take it right here. A quick reminder that we do have two options, the quarterly option and the yearly option. Of course, both options will get you our options masterclass for free, which normally is at $397. You're going to get it completely for free with either option. Of course, the yearly option will give you the better value for your buck because it has well, over the year, it's discounted, and you will get 4 hours of personal coaching. Uh, Now, with this, a question came in from Donna. She wanted to know, can you explain calendar debit spreads and how they work? Well, Donna, that is actually the perfect question you would ask Jim in the one-on-one coaching session. It's a bit out of scope for this particular one, but in the one-on-one coaching session, it would be a great topic to go over. Also, if you look at the masterclass, we're not covering this particular strategy there, but it will build up towards it. So that's something that you will get out of the masterclass as well. But yeah,
And one
yeah,
last thing, Daniel, when you're dealing these multi-leg strategies, which obviously calendar spreads are, what we do in the coaching session is we break them down by legs. Because when you break them down by legs, you can identify where the risks are and how do you have to manage the risk. And with calendars, you're going to have a time risk, and you're going to have a price risk, and you're going to have a premium risk. So there's a few different factors, and that's why the one-on-one coaching, where it's just me and the subscriber, we can go through it at the slowest pace possible, so you really get it. Because again, some of these multi-leg strategies, unless they're broken down, you probably don't really know what you're doing.
yeah, absolutely. So yeah, the one-on-one coaching session would be the right place for this. And all in all, especially since you get personal coaching, which I think is quite unprecedented. This is one-on-one. It's not in a group session. It's one-on-one on the phone with the option professor, where you can really get every single question answered. I think this makes this a great deal. The link is in the chat. It's tradingindicators.com/alerts. All right. So with this, if you have any questions, please reach out to us either at professor@tradingindicators.com. Let me put this email address into the chat as well. If I can find my chat window, there it is. So it's professor@tradingindicators.com. Let me see if I didn't misspell it. Perfect. Yeah, that's for reaching out directly to Jim. And of course, if you have any generic questions about tradingindicators.com, I can always go to our homepage, tradingindicators.com, go to the main menu, click on contact. There's a contact form there. Put your question into the form, submit it, and it will go straight to my inbox. And I will make sure to get back to every single question that you ask. All right, with this, guys, I wish you all a great evening. Thanks, Jim, for joining us. Enjoy wine country. And when will you be back in Vegas? Soon?
Well, I'll be back there to make sure that Sunday alert goes out. That's for sure.
That's perfect. Yeah. So yeah, the next alerts will go out on Sunday afternoon, as you will always get them. And of course, something to always look forward to. With this, guys, have a great evening, trade safe, and talk to you soon. Bye-bye. Thanks, Jim.